The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN. We kick things off Monday morning. Few camera issues this morning, folks, but we'll get to the bottom of it. Nonetheless, let's go right to the charts. We got the S&Ps up by 13 points. Markets in positive territory to kick off a pretty important week. We have CPI data tomorrow morning. Unless we get an absolute shock in the numbers, expect that the Fed is probably going to pause. We'll see how the data goes from there. Nonetheless, the markets have been loving that. They've been loving it for some time, though, folks. We've been on quite an acceleration. You check out the S&Ps just in less than 3 months. We were at a 3,800 handle, folks. We were down March 15th, 3,865. You're talking about almost 500 points added to the S&P in that 3-month period. You know the market loves to be forward-looking. And I would expect, folks, that there is some of this priced into the market. How much is priced in, right? As in a pausing. We've been hiking for 10 consecutive meetings. We've been hiking for 15 straight months. We've been in a hiking cycle. We're going to kick off the news of the day with the Wall Street Journal article with some interesting charts talking about the Fed, what they have to do going forward. CPI data, pretty important number tomorrow. I expect the Fed is probably going to pause, though, unless they get an absolute shocker. They've been pretty clear with their words. And the words matter, especially prepared remarks, especially by Jefferson, who is nominated to be the vice chair. He didn't leave himself any room in terms of what they would be doing, what was the best course of action. That best course of action, in his opinion, when you're nominated to be the vice chair, you're usually going to reiterate the chairman's words. You want to be clear to the market. You don't want any surprises. They made things as clear as possible. And yes, what's so interesting is, in this hiking cycle, we've seen when the chairman had to change what they thought they were going to do because there was data within a quiet period. There would have to be substantial data, and it would all have to come tomorrow. I may sneeze here. Excuse me. Excuse me. Okay. It would have to be a shocker. We find out we get CPI tomorrow. We get the Fed on Wednesday, and we get the markets climbing to higher prices ahead of that news. You back it up to August, S&P's high of 43.27. We get the S&Ps right now. Now, some of this gap going on here, okay, is a difference in contracts, which is going to spice things up a bit on the charts, to put it lightly. They were in the Tiger's Den talking about it last night. And, yeah, pretty remarkable how you see that roll in terms of the contract, the S&P. You go from a price of 43.04. We're technically at 43.62, but nonetheless, you're only up 13 points is what I have it right now on the S&P futures. So going to be interesting to see how those show on the charts. I thought when I woke up, I said 43.70. Wait a second, we were just at 4,300. A little bit of a different story. See how that plays out throughout the day. Bitcoin down about $500, 25,930. We jump over to gold, down about $2 at 1975. Gold's had some volatility recently with the dollar index as well. Silver, a little bit of a drop off just even in the last half hour or so. Silver off about 26 pennies right now at $24.14 an ounce. You jump to notes and bonds on a Fed week. Yeah, we're higher price, lower yield, but you back things up, right? Let's even put it back going on an hourly, 20 days. You can see the volatility as in slightly up, slightly down. We're near the bottom range of that range at 113.17. You back it up about a week ago, and we were up near 114.27. See how that moves this week ahead of the Fed meeting. You got to jump to the dollar index. Dollar index right now, 103.46, taking a little bit of a bigger picture. Dollar, highs of 114. You're backing things up to September. I mean, you're almost going a year now, right? September. What are we talking about? 9 months ago, the dollar peaked out. 9 months ago, man. But we are where we were trading at in the dollar in December. Crazy when you think about the Fed has just kept hiking. Things have been updated. Inflation's been persistent. But nonetheless, you have many other central banks now hiking, yield, competition for yield, pushing demand for those currencies in particular. All right, we got to jump over to the VIX, right? Where's the VIX going to finish out? Now, we did get a sell-off on Friday. So you got some negative action. You got a VIX spiking from 1350 up to 14. Here's what I'll say to you, man. You got an elevated VIX. The VIX was at 13 and change for late last week, and we actually got into a 13 handle, folks, at the end of Tuesday of last week. The VIX is now pushing 15, and we have a positive market to kick things off. Seems like last week was on autopilot. This week, not so much. Right? Last week, there was nothing in the way, man, of the rhetoric that the Fed is about to pause after 10 consecutive hikes. You almost can't overstate how that could change what the market is looking at. Keep in mind that the market has known this is coming for some time, though. And when you take a look at the S&P, when you take a look at the VIX, right, you see the run we've had. As I stated again, you're talking about 500 points, folks. You're talking about almost a 15% acceleration. Let's do it right now to the tick. This is just a daily chart of the S&P. You back things up to 3839. So even if we call it about 500 points, because we just got that irrational jump on the option on the contract roll, in terms of that added like almost a full percent. That added like 40 points to this index overnight in terms of on the futures. But let's just say you take the 500. Okay, and you say where we came from of a price of about 38.39. Percentage-wise, 13%. That's what it is. 13.02%. The 500-point acceleration from where we were. And that's not cherry-picking the low, man. That's not cherry-picking the low of 3,500. That's not picking the low where we were there. That's not talking about where we kicked off the year was also another low. That's just talking about this acceleration over the last 3 months. So there's 13% optimism built in just that alone. And boy, we've talked about, I mean, is Apple going to create another $1 trillion this year? I'm giving some bear cases, man, but there is a lot of optimism built into this market. I know the economy has held up so well, and maybe we have some room left to the upside, but you still have the risk-free rate of return, folks, at about 5%. So, there are some lofty evaluations in terms of, Wall Street. Some analysts out there, they're putting, and we'll get into that later in the program as well, but they're putting, end of year, where are we in the S&P, right? End of year, 4,500. Well, geez, 4,500, what is that? That's now just 138 points in the S&P, which is, check this out, right? That's 3.16% away from where we're at right now. 138 points from 4362. If you're looking for 4,500 in the S&P year end, you're looking for a 3.16%. Let's call it 3.2% is what you're looking to the upside from where we are right now by year end. That's a bullish case because it's higher than we're at right now, and we just popped 13% in the last 3 months. We're up even more than that on the year in the S&P. The risk-free rate of return right now, folks, is about 5% almost. So you're taking 6% to buy the S&P right now for an optimistic view that it goes to 4,500, and you're just barely beating out the risk-free rate of return. We're at some optimistic prices, man. We find out a lot this week. We get CPI data out tomorrow morning at 8:30, and we'll take a look at the Fed with, we'll jump around to some of the news of the day on Monday. Stay tuned, folks. We'll be right back. Don't go away.
We have exciting news, Tigers. This June, Tim Ord of the Ord Oracle will be hosting 2 webinars, providing insight into his renowned market timing methodologies. On June 8th, Tim will delve into the S&P 500, teaching sentiment indicators, identifying market bottoms and divergence, and so much more. On June 15th, Tim pivots to the gold market, taking a look at cycle analysis, ratio studies, advanced decline indicators, and other important tools for analyzing this sector. Sign up today on TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee, so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors. Welcome back, folks. We get the S&P futures up by 11 points right now, trading at 43.60. We jump over to the dollar index, keeping our eye on the dollar index right now, down about 11 pennies, 103.44 on a daily basis. You see, off the lows that we were at just on May 9th at 101.24. We'll see where we go from here. Let's check in on the gold contract on Monday morning, 1973 in that gold contract. All right, jumping around different things I've been reading over the weekend, this morning from the Journal. And yeah, that was out this morning. Nick Timiraos, he's always on the Fed scene, right? He's the guy that maybe they speak through during the quiet period occasionally. I was listening to Bloomberg a week or two ago, and they called him Nicky Leaks. In terms of WikiLeaks, of course, Nicky Leaks. Either way, he has his finger on the pulse of the Fed. And just a few things to note as you come into a pretty important Fed meeting, that they're expected to pause / skip for the first time in 15 months. Okay, remind yourself of the acceleration we've been in, man. When you take a look at this chart, where we are, 2022, the hiking cycle that we're in, extending into this year, 2023 is in the black here. Boy, you talk about going higher in interest rates at a pace that's been faster than we've ever seen. Folks, this goes back to 2015 is in the green here, okay? It took them 3 years to get from 0 to 2%. It just took us 15 months to go from 0 to 5%. That's the reason why you're seeing the Fed giving a pause a chance. It's hopeful, though, folks, okay? It's hopeful because the data is not on the wall that we're going back to 2% just yet. That's the real kicker here. So you have green is 2015. Let's see, 2004 and 1999, either way, 1994 and all the way back to 1988. Nothing like that we've ever seen. So we're going to see how it plays out. They talk about in this article just the general acceleration of rates that we are now at the 5 to 5.25 range. That's where we're sitting at right now. That's where the Fed is expected to deposit. That's where money market rates are at right now, folks. I mean, part of what this talks about here is, your different quotes from different Fed officials. I saw one in here from Neil Kashkari when I was reading it earlier. Here it is. If inflation's going to fall quickly, we might be in a position to be able to cut rates, if not this year, then soon in the new year. If inflation's going to fall quickly, okay? He doesn't say it's going to fall quickly because the data is indicative of that. It's just an if statement based on nothing, okay? There's nothing really out there that says that inflation is going to fall quickly, in my opinion. You can make the reasonable case that it may, just like you could probably make the reasonable case that it may not, though, right? May sneeze again. Okay. But if on the other hand, right? Now, this isn't an interview last month, but it's just talking about how some of the Fed officials feel on the issue. But if, on the other hand, inflation is more persistent and much more entrenched, which many people do feel, then I think the stresses in the banking sector probably become more serious. And that's the real kicker in this, right? And that's probably part of the reason that the Fed is pausing as well. There are stresses on the banks. Bloomberg this morning had Mike Mayo, a Wells Fargo bank analyst, on this morning, and he was talking about the 3 banks in the S&P 500 had failed. Remarkable. And he was making the case that that's over. And he was making the case to buy the banks. And what you have to understand on that, and look, they've gotten hammered, and the good banks are probably a tremendous value right now in the long term. But the banks were ill prepared, okay, for that type of an acceleration in interest rates. They make the point in this article as well that what happened is that during the pandemic, and this is what Silicon Valley Bank said as well, which is just ridiculous, though, that, the Fed had signaled that they planned to hold interest rates at very low levels for years. Folks, we were all out here, okay? That doesn't mean you go buy a 30-year treasury at 1.6% or a 10-year, whatever they were buying, right? Loaning somebody money for a duration period of 10 to 30 years at 1%, as a banker, you should have understood that there was a risk that interest rates would have to go higher. Seemed like the plain obvious, okay? But they did tell us, telegraph that they were going to keep rates low for a long period of time. We were in the pandemic, man. The world was a different place, okay? Travel was not existing. Schools were shut down. Businesses were not operating. Restaurants were not happening. Everything. The economy was, in one way, we worried it was ceasing to exist. Really what it was doing is it was transforming, okay, into servicing people in a different manner. I mean, we all know how curbside takeaway became something that just wasn't at Outback. It was actually at Dick's Sporting Goods. I remember, I've told many times, early on in the pandemic, man, I'm talking about, boy, I got to wrap it up to when exactly. I'm trying to remember what I was buying the shoes for. I was buying shoes at Dick's Sporting Goods. Either way, pretty early on. And I pulled up. It was a curbside takeaway deal, and I found myself being pretty amazed that it was the exact same experience I had had many times for Outback Steakhouse, picking up curbside takeaway. They were one of the early ones that revolutionized that trend in restaurants. And meanwhile, I can now do it with a pair of sneakers at Dick's Sporting Goods. Now that is the norm, man. Target's parking lot is just built out exactly for that. Walmart as well, etc. So what did they do, though, is that they were flooding the market with money. The banks had a huge influx of cash. This is what happened at Silicon Valley Bank and the others. They had more cash than they ever had before. They got it all at once, okay? Silicon Valley Bank had a bunch of tech companies raising money as the market was plowing higher and everybody was doing everything online. Just like consumers had money from stimulus, they had money from their jobs not going away, as many feared, as they transitioned from working from home. So it was a double banger. They got an influx of cash that was generational. They used it in probably the worst way possible, locking in long-term treasuries at very low interest rates. They also have commercial real estate that is back there that is going to cause some problems if interest rates stay anywhere near where they are. And I imagine that's why the Fed is hopeful right now that they can pause and not have to squeeze the commercial real estate market as refinances come up over the next 3 years. I've talked about those articles in the past. Staggering percentage of numbers in terms of how many of those properties are coming up, how many of them are interest-only properties in terms of loans. And when you talk about the change in lifestyle, nobody is working from buildings as much. Office space is not in demand. The values have decreased. The cost of financing has went up dramatically. And many people are going to walk away from those buildings. Who's going to own them? The banks are going to own them. What's going to happen? They're going to have to sell them. And that's going to cause the situation to be even worse. So we should all hope inflation goes down. But I'm not sure that's the case, man. And we get to find out one data point tomorrow for CPI at 8:30 in the morning. We get a Fed decision on Wednesday. And yes, it's not the end of the world, folks, if they pause for 6 weeks. Okay, they have meetings about every 6 weeks is what they do. Not the end of the world if they pause for 6 weeks. And I imagine that's what the chairman's thinking. And I'm not so sure the market is lined up with that because, in my opinion, this is a skip/pause, as in the future is not made up yet, and the data will determine it. And if the lag catches up, we will see. But if it doesn't, man, the Fed's going to bring it, and that may cause some pain. So keep that in mind. Stay tuned, folks. We'll come back to the open. Be right back.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern, for free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We have the market open. You got an S&P up about 0.25% right now. You're up about 10 points, trading at 43.59. NASDAQ 100, you're up about 0.5%, 14,808. You get the Dow up 50 points right now, and the Russell up about 1 point. We jump around to some of the FAG stocks. How do we kick it off? Apple shares up another 1/3%, 181.58. We jump over to Microsoft, up 0.5% this morning. We jump over to Google. You got to keep your eye on these 7 stocks, right? They're doing everything. NVIDIA shares up 1.2%. I saw in the den earlier, is it AMD? Yeah, AMD, they have something going on this week talking AI. They're up 2.7% ahead of that, pushing the highs that we saw a couple weeks ago, 130.79. We jump over to Meta shares. Everything's higher, man. Meta up by 0.6% so far. We jump over to Tesla shares. Tesla up another 1.5%. Pretty remarkable, right? Let's check out some of the banks. Speaking of the banks, JP Morgan, basically flat this morning. See the banks probably mostly flat then. Bank of America is flat this morning. Let's jump around some of the airlines. Travel, American catches a bid. Look at this, up 1.85% this morning. Yeah, look at these airlines trading higher, man. Delta up another 1.5%. United up 1.5%. Let's see if JetBlue. Even JetBlue is positive by 2%. I say that, man. They have been in the doldrums many times. You check out some of those travel stocks. They're all higher. JetBlue is not. Carnival, there's a bid for you, man. What's going on with the travel stocks? Maybe anybody know the den? Is cruising coming back, folks? Carnival up by 6.7%. What do they got going on? They got any news? I don't think so. They got upgraded from neutral to overweight. JP Morgan changing their, that's this morning to 16. Bank of America Securities upgrades the stock as well. Couple upgrades. Let's see how Norwegians. NCLS. So the cruise ships, are we about to do it? Is everybody going to go cruising again? Take a look at this chart long term. Be careful. Now, check out. That's a 5-year weekly. Let me even go back further. So what's crazy here is that I had put this on a chart going, you got the COVID acceleration to lows that you thought cruising was going out of business, and it still may be because they got so much debt. Yeah, and we get Tigers in the den scheduling cruises. Maybe this is it, man. Remarkable that if you just zoom in on this chart, let's do Carnival first, the last 3 years. Pretty well-defined channel line, right? This thing comes into the channel line about February of 2021. We hit a high of $31.52. You bounce around on that channel line many times on the upper and lower boundary lines. You make a low of 611 back in October of 2022. And we finally come off that number April 24th. And as you can see, it's been higher prices since then, man. We've traded from a price point of $9.21 up to $14.14 this morning. So here's the channel line, right? But how cool is this? You back it up, and it was actually in the same exact channel line, and COVID just deviated from that channel line. And where did you come back to? You came right back to that same exact channel line, man. You went to lower prices. You got back within the channel line. That exacerbated kind of the volatility to the downside, and you continued the lower trend downside. This is where channels, folks, our man Bud Rolfs, let me back that up, excuse me. Look how well defined that is, right? So if you're in this thing on a bullish side, maybe keep your eye on that as you hit that. Hindsight's so easy, of course, but pretty remarkable. And on that same accord, we got a breakout here, man, of this channel line that you could make the case, okay, that if COVID just accelerated things and got irrational, that you've been in this channel line almost since September of 2017. You're talking about 6 years where you traded from $72, even the beginning of 2018, down to $6. Now you're breaking at $14.14. Norwegian, a little bit of a different story in terms of you don't see that channel line beforehand. There is your COVID drop-off. So you saw, right? Carnival was in a downtrend channel. Norwegian, they were just chopping around near highs of about $60. We're trading right now at $17.87. They're getting a breakout as well. All right, back to talking a little bit of Fed. I was looking at CD rates today again. It's important to keep your eye on them, man, because I don't think many people realize the CD rates because you're getting Treasury rates, right? Many times, what's the 10-year trading at today? Let's pull it up right now. The 10-year is trading at 3.74%. That's the yield on the 10-year Treasury right now, okay? 3.74%. But if you look at what you're getting for a CD right now, A 2-year ladder locks you in at 5.2%. A 5-year ladder locks you in at 4.79%. And just a 5-year CD, so that's not a 1, 2, 3, 4, 5 averaged out for a 5-year ladder. A 5-year CD non-callable today, 4.5%. Okay? That's a remarkable risk-free rate of return. One of the things they talk about in this article is, man, all the hysteria of the bank runs, okay, with Silicon Valley Bank and the others. Let me get to the part because it makes a case, folks. The run on Silicon Valley Bank risked waking up sleepy depositors to the possibility of earning more on their money by moving it elsewhere. This isn't just talking about the run on the bank. This is talking about, I believe rightfully so, because I wanted to make the point, that many consumers outside of the financial literate folks, okay, many consumers are much more aware right now of the interest rates that are available to them outside of, I mean, check it out. The average yield for traditional saving accounts right now is 0.25%. Imagine how people are getting away with that when you should be earning about 4 to 5% right now across the board for pretty reasonable accounts with FDIC insured institutions across the board. The worry is that the events of the past few months are for banks what the pandemic was for Zoom use once people were forced to figure it out. I would say that's the case. The Fed is watching 20 to 30 institutions they see as more vulnerable following the spring's banking turmoil. And you look at the deposits, man, okay? We got large banks in the light blue here. We got small banks in the darker blue. Look at their deposits when they peaked out in March of 2022. Large banks, what is that, 1.3 trillion? Small banks, about 700 billion. They're now both sitting at about 309 billion. Yeah, large banks were at 1.2 trillion, man. Now they are hypercapitalized and they're doing well. The small banks go from 733 to 2, what are we at? No, that's the large, about 300 billion. Not as hypercapitalized. You're seeing the strain on them in particular. Now here, how about this tidbit? Any lending downturn could hit small businesses harder than large ones. Okay, we've seen the biggest companies in the world fare well. That's probably what's going to happen if we face some stress here in the banking sector. Take a look at the number. Banks with less than 250 billion in assets are responsible for 70% of all lending to firms with under 100 employees. So you have the regional banks, banks with under 250 billion, still pretty sizable banks, some of them, right? Responsible for lending $7 out of every $10 to companies with under 100 employees, which are some pretty sizable companies still when you're talking about companies with 20, 30, 40, 50, 80 employees, right? Some stark graphs out there, man. It all hinges on inflation. We got some CPI data out there tomorrow, and then we got Fed. We got market trailing off. S&P's hanging on to gains by 3. You got the Russell in negative territory. Stay tuned, folks. Lots to talk about. We'll be right back.
We have exciting news, Tigers. This June, Tim Ord of the Ord Oracle will be hosting 2 webinars, providing insight into his renowned market timing methodologies. On June 8th, Tim will delve into the S&P 500, teaching sentiment indicators, identifying market bottoms and divergence, and so much more. On June 15th, Tim pivots to the gold market, taking a look at cycle analysis, ratio studies, advanced decline indicators, and other important tools for analyzing this sector. Sign up today on TFNN.com. TFNN, educating investors.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The Gold Report. As a precious metal, gold is still king. It continues to hold the most effective safe haven and hedging properties across the global major trading hubs of the London OTC market, the U.S. futures market, and the Shanghai Gold Exchange. The Gold Report. Tom O'Brien publishes his weekly gold report every Monday morning for subscribers, consisting of coverage of the XAU, HUI, GDX, the dollar, bonds, the South African rand, as well as 25 different mining equities with specific buy-sell recommendations. The Gold Report. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. Subscribe to Tom O'Brien's Gold Report newsletter now at TFNN.com.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the fund is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. We got markets green across the board right now. S&P is up by about 10. You got the Russell back in positive territory. Look at that spike, man. Russell down to 1880. We're up to 1890 right now, positive by 4 points. Let's check in on the dollar index right now. You get the dollar index basically flat at 103.56. We check out the gold contract, down about $5 in 1972. We jump over to the volatility index. Just keeps going up, man. VIX. What's going on? We got positive markets, and we got a VIX pretty elevated. We were at 1350 on Thursday and on Friday. Today we're at 15. Different week, folks, okay? Last week might have been like Cinderella. I'm serious, as in there was nothing to get in the way of the narrative that the Fed was going to pause. That is now priced in outside of some type of shocker CPI tomorrow. And we don't need shocker CPIs, okay? The numbers expected to wane a bit in terms of where we are year over year. But we still got some pretty high numbers expected on CPI. So don't think that just because we might get the pause this time, we're not going to get a huge miss on the numbers tomorrow, that inflation is under control. It's still estimated to be in between about 4 and 5%, man. So we have a ways to go, even if it doesn't have to come from this meeting right now. One more chart from that article I was talking about from the Journal, folks, because you got to keep it in the back of your head, man. These banks are still borrowing a lot of money from the Fed. This is bank borrowing from the Federal Reserve as a share of their assets, okay? I mean, you got above this in 2008, 2009 when we had the crisis, but we still got some pretty lofty levels we're dealing with here. This is not under control. Inflation is still raging, and the Fed may even have to go higher from here. And they're watching, did you hear it? 20 to 30 smaller institution is what the Fed is now keeping a little bit of a closer eye on. Because guess what? They aren't certain that inflation is going to be under control either. They know at least the risk is out there that their pause does not work. They need to go higher because we cannot stay at 4 to 5% inflation, folks. It's not going to happen. Not with unemployment at 3.7%, okay? That's where you have to square all of this. The market is up dramatically this year. Unemployment is under 4%, and we can't get rid of inflation. That means the Fed needs to bring it more. If that happens, be prepared for it, okay? And look at charts like that. Now, let's look at some of the different calls on Wall Street. You talk about Morgan Stanley, you talk about Goldman, they're at odds. Now, here's what I'll say is that the bull side of this is this 4,500, and that is the price tag I was thinking about in my head, Goldman. They're looking for the year-end target of 4,500. Well, I walked you through at the beginning of the program. That's about a 3.1% rise from where we're at. And you'd have to hold that for about 6.5 months. That's almost the risk-free rate of return right now, folks, okay? So this article puts the bull case at the risk-free rate of return and the bear case at a steep, dramatic sell-off. That might be the risk-reward calculation right now. And if that's the calculation, man, you shouldn't be taking that risk in equities. And I'm not telling you that, okay? Even in retirement, you want to have some exposure, man. We may be at the beginning of an AI boom that's going to have productivity through the roof. I mean, in theory, I was talking with friends about this weekend, going a little big picture, right? But AI, the whole conversation is, man, it's going to take so many jobs. And it is going to take so many jobs. In particular, it's going to take certain industries of jobs. When you talk about copywriting, right? You talk about the writers are on strike in Hollywood right now. That may be a really tough negotiation, man, because I imagine the studios are well aware that a majority of the work that copywriters are doing, writers in general. Now, listen, we're not there yet, man. You read some of the stuff, okay? You're going to need editors. You're going to need, the new version of a writer is going to be, how are you able to prompt AI and how are you able to edit AI? And the finished product is what you have assembled as a writer, collaborator, and editor using technology that exists today, such as AI. You're going to need humans in there. Maybe not forever. Right now you do. But it's going to cut down on a lot of those costs, right? You could have a team of X amount of people. What is it? 5 people? 4 people? 2 people that are responsible for writing scripts for an entire studio. You really could, because you have AI spitting them out and your job is to edit them and perfect them, etc. So you're going to see that play out. But also what's going to happen is, what's that going to do? It's going to increase margins. Companies are going to, in theory, make more money. That's why they're so willing to invest in AI right now. They then will have more profits, and you can take those profits to invest in different ventures potentially. You know, they're going to reward some of their shareholders for sure. But that is the theory, that you increase profitability, you increase margins. Technology creates fields of business that we can't even think about just yet, right? Cloud computing. Think about cloud computing. Think about the value to the stock market that has been created by cloud computing. Think about the amount of technology jobs that exist around the internet right now, when the internet has put so many jobs out of business, etc. Think about the amount of people that work for Amazon right now, etc. So it's going to change the game. We'll see what happens. We could be at the beginning of the boom of that AI. So there is bull case, man. If you're, somebody investing in retirement, keep putting money away, man. Put it in the S&P 500. The market's going to be fine. If you're a trader right now, though, and you're looking for a risk-free rate of return that is compared with the bull case on the market, that's where I start getting a little nervous, man. Because in one case, you got Goldman saying 4,500, which again is up about 3.1% over the next almost 7 months, okay? And then you have the bear case, Mr. Wilson from Morgan Stanley, and the one chart I really wanted to get to in this article talks about the comparison to the 45 to 49 boom bust market. Now that's where you had the stock market rise 24%. You had a bear market in the 40s, you had the S&P rise 24%, and then it returned to a new low. Up here you have the S&P 500 on the top portion of this chart from 1945 to 1949. Actually making a new low. Now, it didn't decimate that new low, okay, but it's quite a substantial pullback when you look at it on a percentage basis after you had risen some 24%. Now, he's making the comparison early on in this chart that could be what's happening here, okay? So there's the bear, there's the bull. We get to find out. Tomorrow's an important number. I imagine the Fed is going to pause/skip on Wednesday, but keep in mind, folks, that, again, I'm going back, and we're going a little big picture right now, okay, but it's important because this is a big picture moment that you come into for the Fed that's going to be pausing when they've been hiking for 16 months. The one thing I'll say is when they hiked, okay, let's back it up on a daily. We'll really zoom in on the action last March. March 14th, March 15th, we were down at a price point of 41.62. That's when the Fed began their hiking cycle, folks. The market accelerated into that over a period of 3 months to lower price and then actually caught a bid. Well, what have we done? We've accelerated higher for a period of about 3 months into what? The end of the hiking cycle. Well, what if we get a little bit of a sell-off, right? Buy the rumor, sell the news. We get the news on Wednesday. Stay tuned, folks. One more segment. Don't go away.
TFNN has just launched their new trading room, the Tiger's Den, hosted at Discord. TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We have the markets in positive territory. You got an S&P up about 10 points. Remember, on those futures charts, right? You're seeing a jump from about 4,300 to 4,600, but you have the difference of contracts there. I mean, you jump over the SPY if you want some simple reference. You got the SPY basically trading up 97 pennies or 0.23%. So don't get caught up in the difference of price, but it is kind of stark. You wake up and I say, wait a second, man, we're at 43. Are we going to push 4,400? We're at 4,300 on Friday. Well, the difference in contracts, it matters. And if you're looking at the S&P, folks, you're looking at golds, okay? Last week was the S&P. This week is the gold contract. If you're looking to trade gold, folks, Tim Ord has a live webinar coming up this Thursday, June 15th. That's only 3 days away. You can get into that gold trading webinar for $295. You can sign up, folks. That takes place in our Discord server. Very simple to do. It will be archived, and if you'd like to attend the archive of the webinar he just did on Thursday as well, great webinar, 2 hours long. I was in there with many Tigers as well. You can sign up for both if you want. You can get the archive, but I encourage you, the Thursday one, that'll be live. There's a question and answer period at the end of it for the gold trading webinar. And yeah, we have currencies in fluctuation. We have gold in fluctuation, to put it lightly, man. That's why I keep checking the dollar index, because dollar index is doing so much these days, man. You check out the dollar index, look at this action, man. From 103.24, this is a minute chart, but just to illustrate the run, to 103.70, just like that, back to a 15-minute. We're just back to where we were pre-market in the dollar index at 103.70 right there. And you jump over to the gold contract this morning, you got gold. Yeah, I mean, that's you know, look at that, right? Didn't even know it was moving. I should have the moment I pulled up the dollar index, man. You get a spike like that, and gold is going to matter. Yeah, and gold dropping. We got dollar strength right now. Let's check out yields. So what do we got? Look at this. We got higher yield. This is a move, man. We got higher yield, we got a stronger dollar, and we got markets in positive territory ahead of CPI data out tomorrow. And you got a treat. You got a man, Basil Chapman. He's coming up live next, folks. He's on the road. He's remote, but he's ready to do the Tiger Technicians Hour. He's excited, so stay tuned for Basil coming up next. Live programming after that. Markets in positive territory. It's Fed Week, folks. Stay tuned. Basil's up next. Have a great Monday, everybody.